You don't need 20% down. You don't need to be rich, and passive income isn't always passive. In today's video, I'm going to break down the 7 real estate myths that are keeping you broke, scared, or stuck. Let's dive right in. The first myth I want to tackle is that you have to have 20% down in order to buy a property, and that's simply not the case. You can use lower down payments typically with hard money loans that are going to be more expensive, or in my experience, I've typically used private money, meaning borrowing from folks that I know or have met, some in person, some online. My earliest private lender was a guy I met on real estate forums known as BiggerPockets.com, based out of Australia. I was hopping on WhatsApp at like 1 a.m. in order to make calls that made sense in his time zone. It's how I funded my first several projects. Sounds a little scammy, but it totally worked out for me. Historically now, I'm using private lending at 8% APR. I'm not putting anything down, and I'm even holding my payments to the end. My first couple rentals, I put 20 or 25% down with a local community bank, but then I got to the point that I was getting such good deals that my bank would refi out most of all of my capital, or sometimes even more than that, back when we were buying a whole bunch of rentals. If you're looking for a home for you personally, you can use something like FHA. My first personal home, I did a 3.5% down FHA deal, and it worked out great. You might find somebody locally that's willing to lend to you on terms or like owner financing, or you could even go with something like a secondary property loan if you're trying to get into investing, and that might be more in the 10 to 15% down range. Many of the investors I personally know didn't come from money and started out with relatively little and have kind of carefully managed that into something more impressive. The second myth that I want to bust that's going to break some of your guys' hearts is that real estate investing is passive. Could it be? Sure. But for most folks, it is not. I have tons of folks I've worked with that own rental portfolios. Some have property management, some do it in-house, but there is some level of effort that is going to go into real estate investing, particularly on the passive income side. Properties have to get remodeled. Tenants have to get vetted. Leases have to get signed. Taxes have to be filed. In my experience, the most like passive income you can get is simply being the bank for somebody else, which works great if you have hundreds of thousands or millions of dollars just sitting around. But like when I started, I was wholesaling and flipping until I got to that point that I could be the lender on some folks' deals. I do like to just like add value in these videos. So a pro tip here on the tenant screening, one of my favorite services we used was something called Red Star background checks. They would do our tenant screening. They would verify income, employment, and even provide for us a like accept or decline recommendation. Third myth. Now is a bad time to buy. Now is a bad time to pay retail, but now is not a bad time to buy or get into real estate investing. I look at real estate investing through the lens of dollar cost averaging. If you're not familiar with dollar cost averaging, it comes from the stock investment world, but it's the idea of we put in capital a little bit at a time, daily, weekly, monthly, but on some sort of clockwork schedule versus like trying to time the market. There's the old expression of time in the market is always superior to trying to time the market. I would actually argue now is a great time to get involved in the market because it's less sexy. It has less attention. People are focused on AI and other things now versus real estate. The smartest investors I know are going to ask the question, where is the opportunity here, versus burying their head in the sand saying there's not one. There's folks I know that I could name in this video, but I won't, who for the past 10 years have been telling me it's a bad time to buy. At this point, I just think they're kind of like professional bench warmers. The fourth myth we should hit is that you have to have a real estate license in order to be involved in real estate. And look, I'm personally licensed and I have been since 2016. There's not really a better data source than being able to pull comps from the MLS. It also gives you a lot of credibility with lenders, title companies, even buyers and sellers. I think getting licensed makes sense for the average person, but I didn't have it for my first several deals. I wholesaled, I fixed and flipped, I owned rentals, all prior to getting my license. I believe that if you're active in real estate, seriously, getting your license is an asset. The pushback I typically get to that is like, well, that complicates disclosures. And well, I'm not lying to people in order to get good deals on houses. I've bought and sold hundreds of properties, and I've never had a single issue with my license. The fifth one that I want to address is that you're not a real estate investor if you're not doing buy and hold real estate investing. I know people with large portfolios right now that are losing money and even selling assets in order to pay their bills. I'll be the first one to tell you that you can't use equity to pay your light bill. However, building a rental portfolio does have a lot of benefits. You can take lines of credit against it to fund other projects. As those properties appreciate, your net worth increases. You can also take advantage of depreciation to lower your taxable burden. But that doesn't mean that you have to do conventional buy and hold. You might be more interested in like short-term rentals or 30-day stays. Realize you're getting more into like the hospitality business than the investing business. But if that's what you're passionate about, if that's what you're interested in, then go for it. As I've said multiple times on this channel, I'm a big fan of the transactional stuff and rolling that into more long-term plays. I might take a listing on something to take the commission to roll that into something more long-term. Doesn't mean there's anything wrong with doing the transactional side. I would actually argue every buy and hold portfolio needs some sort of a transactional arm. That's how we cover when we have an overage come up or a big surprise. That's how we control our own deal flow. I would argue just doing buy and hold and not being able to source your own inventory puts you at a significant disadvantage. The sixth one I want to address is that you can do real estate investing with no credit, no capital. This is a common angle that I see used in order to push courses and signups. Now, I'll be the first to tell you, you can do deals without your own capital or without having to have credit, but they make it a lot easier. Finding a property that we can buy at a discount that has tons of margin where we can make a bunch of profit on it, whether it's a flip or a rental, is a little bit of like finding a needle in a haystack. Finding that scenario where somebody doesn't care about the fact that you're not paying your bills on time, or that you've been evicted, or that you currently have things in collections and that you don't have any money to put any skin in the game is going to be more difficult. I know it's not popular, but it's realistic. Credit and capital are huge assets. The best source of debt is always going to come from local community banks that carry the paper in-house. They offer the best terms, but guess what? They're going to want to verify your ability to repay. Some workarounds could be partnering with somebody who has good credit, finding an older owner that's retiring or is willing to offer terms or something along that nature. The seventh point I want to hit is that real estate is risky. Now, I have preached on this channel about real estate does carry risk. It takes credit, it takes capital, it takes hard work and time and all of these other variables, but all of those variables can be mitigated. I think it's Jim Rohn that had the quote of, "Life is so risky, none of us will get out of it alive." The lens that I view real estate through is that I can mitigate risk by mastering the various aspects of it. If I don't understand construction, that's most likely where I'm going to get hurt. I learned that lesson early on. If I don't know how to find a good deal, the deals I buy is probably where I'm going to get hurt. If I don't understand accounting, what a P&L and a balance sheet is and how to know where my dollars are, that's where I'm likely to get hurt. Real estate does carry risk, but I believe it's a risk that's worth embracing. Now, transparently, you're talking to somebody that paraglides and rides sport bikes, and I do things that a lot of folks might consider risky or even reckless. That being said, I'm obsessed with mitigating that risk and attempting to control those variables as much as possible. I'm not going to go ride a sport bike on 4th of July after everybody's been out drinking and partying. I'm home by like 5, 6 p.m. if I go anywhere. Real estate absolutely changed my life, and I believe that it can do the same for yours if you're willing to master the craft. Mark Ferguson has a quote I love of, "It's the best way for the average person to become wealthy," and that's something that I still believe. How I've always treated real estate is like a bowl in a china shop. I'm going to take a step forward every day, and I'm going to learn from the mistakes I make as I make them. Make sure that you don't get stuck in analysis paralysis and at the end of your life wonder, well, what if? If you haven't already, be sure to like and subscribe. My name is Ryan Dossey. I appreciate you hanging out with me, and I'll talk to you next time.